Tonight I'll be discussing the volume zone and price zone oscillators, which were developed several years ago by Walid Khalil, a member of IFTA. Walid he originally developed the oscillators for his paper that he had to write, and I ran across Walid a few years ago. It was more than a few years ago now, and we discussed. I thought they were absolutely brilliant. He was doing something no one else had done, and when I saw it, I asked him some questions. Well, how would you use it to trade this? How would you use it to trade that? And essentially, he hadn't thought that far ahead, so I said, well, what if we did X, Y, and Z to it? So I kind of put my own spin onto the oscillators. I give Walid full credit. The way I'll do the presentation tonight, I'll go for approximately a half an hour, 35 minutes, then we'll take about a 5-10 minute break, and then I'll complete, and then I'll take questions, and hopefully we'll have internet access so we can look at what's going on in the United States. We're going to discuss two oscillators tonight, volume zone and price zone oscillators. We'll start with volume. As you know, volume analysis is a key component of analyzing and predicting future directional behavior of an asset. One of the earliest proponents of using volume in his work was Joe Granville, who developed unbalanced volume. OBV added a period's volume when the close is up and subtracted the volume when the close is down. Time is not relevant to unbalanced volume, according to Joe. Volume zone oscillator takes into account both time and volume. Once upon a time, and please, this is not intended as a criticism of Joe Granville, but nowadays to not take time into consideration in your analysis, I think is very foolhardy. The volume zone oscillator, the VZO, takes into account both time and volume. Am I speaking loud enough, by the way? Can everybody hear me? Okay. The VZO smooths volume and plots its action in the form of an oscillator, not as a trend following indicator like unbalanced volume. By the way, when I get back to the States, I'm going to send Alex a copy of this PowerPoint, which he can pass along to everybody. So don't feel you need to break your wrist trying to take notes. I know it's being recorded, but I will give it to Alex. I guess if we pay enough money, he'll give it to you. The modifications of the VZO and of course the PZO take the form of a leading indicator that provide buy and sell signals based on oversold, overbought behavior. One of the fundamental truisms of technical analysis is that, excluding volume, all indicators are either trending or non-trending in nature. For example, moving averages are trending indicators. You have a smooth, as long as you've got a decently smoothing market, trending market, you can use a crossover, etc., as a fairly good timing indicator. But if the moving average starts getting choppy, let's say you're using the moving average crossover to make buy and sell decisions, you're going to get whipsawed. Non-trending indicators work very well in choppy markets. Good example would be RSI, or, well, I'll just say RSI. But the minute the market starts trending, we've all seen, well, gosh, it went overbought, so I sold. But it kept rising, the stock kept rising. Or it never reached oversold condition, yet the stock kept falling, because non-trending indicators tend to be less reliable in trending markets. The VZO and PZO are useful in both uptrending, downtrending, and sideways markets. Really quite unique in that regard. Okay, we had the wrong password. So as I was saying, the VZO and PZO work very well in both uptrending, downtrending, and sideways markets. Very unique, even though these are oscillators. The formula is quite simple. If today's closing price is higher than yesterday's closing price, volume has a positive value, which is bullish. Otherwise, it has a negative value, which is bearish. This is similar to what Joe Granville did with on-balance volume. Now let's talk a little bit about price. We've been talking volume, now let's discuss price. At the end of the day, price discounts everything. One of the things that I always tried explaining to clients, for 24 years I worked in the finance industry, either as a stockbroker or as an investment advisor. And people were very interested that you took away the username. You just gave me the password. I don't know the username anymore.
With your
No, it didn't work.
Okay.
Now, where were we? Okay. One of the things I would tell clients when they found that I did technical analysis, very interested about it, is it's all good, it's all grand, but it doesn't mean diddly squat if price is going down regardless of what the indicators say. Price discounts everything. Price determined by the interaction between demand and supply. Anybody who's ever read anything I've ever written on any bulletin board, any chat board, I'm famous for saying, how come XYZ went up? More buyers than sellers. How come ABC went down? More sellers than buyers. Oh, there always has to be someone on the other side. Yeah. When demand increases relative to supply, price goes up. When demand decreases relative to supply, prices go down. You go into the grocery store, if they have tuna fish on sale and they're not selling enough of it, what do? They lower the price. They try to increase demand by lowering the price. Eventually there's an equilibrium. And if a product is flying off the shelves, if it's a smart merchant, he's going to raise prices. Look at that. Look, I just read in the Evening Standard, is that the name of the newspaper? I read it on the tube coming over here. In the last 6 years, home prices are up 50%. Demand is driving price. Price discounts everything. You can have all the analysts in the world telling you why home prices shouldn't be going up. They're going up because price is the bottom line. Price is the order. The price zone oscillator, like the volume zone oscillator, is useful in uptrend and downtrend and sideways markets. Conceptually, it's the same as the VZO. And the formula is the same as well. If today's closing price is higher than yesterday's closing price, then the closing price is a positive value, which is bullish. Otherwise, it has a negative value, which is bearish. All right. One of the things that I really like about VZO and PZO, it very much attracted me to the lead's work, is it follows the maxim KISS. Keep it simple, stupid. Yeah, you're going to have a copy of this in a few days, the PowerPoint.
No, I'm not. I'm photographing you.
Oh.
But just carry on.
I would have put on a tie. Keep it simple, stupid. How many of you are familiar with the pitfall of over-optimizing a strategy or technique? Has anybody fallen guilty to that? It back-tested perfectly. It has 28 moving parts. But boy, did this work great when it was back-tested. And then when you either walk forward test it or God forbid, actually try to trade it, it fell apart. In fact, you'd have made a lot more money if you did just the opposite. Let me tell you something. I was in the business for many years. I still trade my own money, my wife's money, my brother's money. Friends of mine, same situation. Business for many years now, retired. We talk all during the day. I'll get a call. I got an email from a friend of mine. Yesterday, I got it this morning. He says to me, dude, do the opposite of what I do, you're going to make a hell of a lot of money. and he's been in the business as long as I am, a very excellent technician, and it happens because over-optimization leads to mistakes. The simpler the system, the simpler the strategy, the fewer moving parts, the greater the likelihood it will work in the future. The term is robustness. The VZO and PZO are a robust analytical indicator. Only 3 moving parts. A 60-period EMA. I say period for a reason. The VZO and PZO work on daily charts, on weekly charts, on monthly charts. They work well with intraday charts down to 15 minutes. Get shorter than 15 minutes. Unless you're trading futures, you're not going to get enough of a price move unless you're trading billions of shares for it to be meaningful. I've backtested the VZO and PZO in various time intervals. I'm comfortable using it with 60 minutes and longer. 60-minute, and then daily charts weekly, or maybe 100-minute or something like that. I'm not comfortable using less than 60 minutes. Just I never made enough money. Backtesting didn't give me enough of a return. But as they say, your mileage may vary depending on what it is you're trading. A 60-period EMA, a 14-period ADX, and 7 oscillator zones. Plus 60, plus 40, plus 15, 0, minus 5, the minus goes to this 40, minus 40, and minus 60. I'm going to show you what the chart looks like in just a minute. But it's only 3 moving parts. Volumes on oscillator clarifies money flow. VZO discerns bullish volume and bearish volume and is useful for identifying at which zone volume is positioned. A maximum technical analysis, Alex and I were talking about this beforehand, follow the volume. Follow the volume. The VZO is plotted on a vertical scale of plus 100 to minus 100. It's a typical oscillator in that regard. Movements above plus 40 are overbought. Movements below minus 40 are oversold. Movements above plus 60 are really overbought, are extremely overbought, and below minus 60 are extremely oversold. The zero line's equilibrium. The VZO movements and its money flow analysis also explain Dow theory's trend phases of accumulation, public participation, and distribution. You're all in the MTA. Presumably you're all studying for or have taken level 1, 2 exams. I know you learned this, but we're going to look at it again tonight. We're looking at a different point of view. All right. This is the Dow Jones Industrial Average Weekly. I apologize in advance. Most of the charts, except for one in this presentation, are United States stocks trading on U.S. exchanges. I'll be coming up with the United Kingdom ETF chart in a few minutes, but the principles work the same, regardless of whose exchange, whose bourse we're looking at. Number one, this is a period of public participation. We have a trend, again, this is a weekly chart, a trending market, trending higher. How do we know it's trending? Because we have a series of higher lows and higher highs. How many of you are familiar or know of Dave Landry? I know Alex does. Anybody, have you ever heard of Dave Landry? Dave Landry, he's an American technical analyst. He's absolutely brilliant with his work. He's published several books. Dave Landry is best known for what he calls the big blue arrow. You know, I'll tell you something funny. And I taught for 11 years. I was an adjunct professor at a university, and taught business law, investments, and personal finance. And I usually used a screen like this, but there was also a whiteboard behind it. And one day I forgot the screen was done, and I took out the marker, and I was about to do it here. And I was drawing all over this. And then when a slide changed, how come those lines are still here and they couldn't erase them? And I realized, oh my goodness, I put it on the screen. I'll keep these away from me. Dave Landry is very simple. He calls it the big blue arrow. And he draws it on his charts with a big blue pen. And do we have a series of higher lows and higher highs? The big blue arrow is going from lower left to upper right. Is it lower highs and lower lows? The big blue arrow is going down. He says, take all your analysis and do whatever you want with it. Look at a chart. Is the blue arrow going this way, or is it going sideways? What we're looking at here in this period 06 to 07 is a series of lower highs, of lower lows, higher lows, and higher highs. Down here, we have these zones. Now, in a few other charts, you're going to see they're colored differently than this. But what we have here, in the middle is 0. On this particular chart, we have plus 40 and plus 60, minus 40 and minus 60. This particular chart doesn't have the minor bands of plus 15 and minus 5. You'll see them in the later charts. Waleed didn't really do a lot with those, but it's the difference between trading for a living and just writing about trading. When you actually use it, that's where it comes in handy. But conceptually, this is how it works. 0, overbought, really overbought, oversold, really oversold. But take a look at this. This is important. In a period where the market is trending higher, note that the oscillator tends to reside between 0 and plus 60. It can dip below it a little bit. But generally speaking, it stays above 0. When it falls below, it's usually not more than, again, these are weekly bars. It's usually no more than 2 or 3 bars. And in this case, it would just be a week, 1 to 2 weeks. We get to period 2. The market is still making higher highs. But for the first time, the VZO failed to make either a higher high or at least come close to the old high. This is a bearish divergence. We're going to talk more about this later on in the presentation. Divergences are, in general, are one of the most powerful signals there are in technical analysis. And they can either be bullish or bearish, depending on how they are. We're going to look at examples of both. You don't use them for timing. You wouldn't, today's the day I'm going to buy or sell because of a divergence. But they throw up a yellow flag. You throw up a flag to let you know, heads up, something isn't right. Something's not working as it should. Price was going up, but the volume zone oscillator was starting to dip. And here at this point, it made its lowest low, VZO made its lowest low in 2 years. And the date was August or so of 2007. Now we move into 2008. Of course, you all know that the US market totally crapped the bed in 2008. Price, Dave Landry's big blue arrow, here it was going like this, now it's going like this. Lower highs, lower lows. The VZO made its lowest low in 2 years, confirming the price action. Remember, this is 0. And at point 4, when the Dow attempted to rally, and I don't have it on this chart, but it was from here to here is approximately a 50% Fibonacci retracement. And as you know, Fibonacci analysis, until an asset retraces 61.8% or more of its preceding move, we consider the preceding move to still be intact. In other words, the market was going down, it only retraced 50%. If it doesn't get much higher, we consider the downtrend to still be in effect. For the first time since we started measuring, the VZO failed to reach plus 40. This is a big red flag on the market. And of course, as we went later into 2008, the market absolutely fell off a cliff. Just like, while this is a period of public participation, this is a period of public get me the hell out, where people were just throwing stuff out right out the window. Now, look at a parallel here. Just like in a rising market, we saw VZO pretty much remain between 0 and plus 40, plus 60. When we are in a sustained downtrend, the big blue arrow is going this way, VZO and PZO as well tends to remain between 0 and minus 40 to minus 60. Come October 2000, March of 2009, the market attempted to rally. Well, let's forget about what you see here. Let's forget that you know what happened after March of 2009. All you know is it tried it here, it tried it here, it tried it here. So what? It's trying it again. But what was different? Let's look at where VZO was each time there was a rally attempt. At point 4, it never got up to 40. Here, I'm going to have to talk about it. It barely got above minus 40. Here, it went down to minus 60. But here, I'm not talking about week 1, week 2, but a few weeks in, well, all right, VZO sort of double topped here. Well, double tops normally are bearish, meaning it's a top. But then a few weeks later, boom. It popped up, the price popped up to here, into this resistance zone. But look at the VZO. VZO, for the first time in several years, you see the first time in about 18 months, got above plus 40. And then, when price pulled back, it came down just below 0, and then we got this big candle up, and boom, and we're right back to where we were here. What you expect to see in an uptrend, staying below 0 and plus 40, plus 60. Of course, we know that the market went on a sustained advance since then. Okay. So, as I said, 7 oscillator zones. It'll be hard for you to see these colors on the screen, but when you have the spread, when you have the PowerPoint on your own computers, you'll be able to see the colors much more clear. This is how they're marked. Plus 40 and plus 60 are green, minus 40 and minus 60 are red, minus 5 light blue, plus 15 is gray, 0 is black. Okay, that's the introduction. Let's go over the system rules, the trade. Again, this is part of KISS. This is one of the things I really liked about Walid's techniques is it isn't, one of the things that drives me crazy, and it works, I'm not saying you can't make it work, but you know, my mind has turned into a piece of Swiss cheese. You've got like 13 steps, it'll come to me. It'll come to me. It's like 13 steps, and it's got to be in a certain order, and never mind, it'll come to me. I apologize. All right, what are the system rules for VZO and PZO? Why don't you tell me briefly, ADX, how do you use ADX? What do you use ADX for?
trending, non-trending.
How do you use it?
Above. Personally, above 20 trending, below 20 non-trending.
Right. ADX measures the strength of a trend, not the direction. You could have two stocks, one climbing at a 45-degree angle, one falling at a 45-degree angle. In the same time period, they'll have the identical ADX. It's like an absolute value. Right? Most people use ADX exactly like you described it. It's the way I use it myself. I use slightly different values, but conceptually it's the same. Above a certain value, you're trending, and below a certain value, you're not trending. And typically, that's 20 to 25. With the VZO and PZO, we use 14. 14 is the discriminant, or the determinant, between trending and non-trending price behavior. Excuse me, I mean an 18.
14 period.
We use a 14-period ADX, and we use 18. If ADX is greater than 18, we say the asset is trending. And if it's less than 18, it's non-trending. There's no thinking here. I'm a big believer of no brains, no headaches. The less I have to think, the safer my accounts balances are. I like very black and white. I don't want to have to think about it. Greater than 18, I'm trending. Less than 18, I'm not trending. The next thing we look at is the price of the asset above or below the 60-period EMA. If it's above the EMA, it's bullish. If it's below the EMA, it's bearish. So, let's put this together. It's very simple. We have an ADX above 18 and prices above the 60, let's say day, 60-day EMA, we can say there's a bullish trend. If ADX is 20 and prices below the 60-day EMA, we've got a bearish trend. If ADX is below 18, we don't care what the relationship is between price and the EMA. Why is that relevant? Because if you're looking to buy something, using these techniques, you only want to buy when, let me step back. If ADX is above 18, you only want to buy when price is above the 60-day EMA. If ADX is below 18, you can buy even though price is below because you're non-trending. And we're going to look at how that's done a little later. All right. This is a chart of the S&P 500 index ETF in the United States using TradeStation, which is the quote platform and charting platform that I use. And this is what we'll be looking at, various charts like this, through the rest of the presentation. The upper half of the chart is price, bars. These are Japanese candlesticks. A 60-day, these are daily charts unless said otherwise, a 60-day EMA. In the middle is your VZO or your PZO, in this case the VZO. And in the bottom part of the chart is the ADX. The horizontal line, this blue horizontal line, is 18. And we're displaying it as a histogram. Plus 60, plus 40, plus 15, 0, minus 5, minus 40, minus 60. Now I'm going to jump ahead a little bit, but I want to ask you a question. All right, plus 60 minus 60, plus 40 minus 40, plus 15 minus 5. Why aren't these the same? Why do you think these aren't the same? All right, I'm not going to answer. Let's see if later on we can figure out the answer. But this is what you're going to see. This is the oscillator. And this, even though this is a daily chart, you can see when price is in a rising trend, the VZO tends to remain above 0 from between 0 to plus 60, fall below the 60-day EMA. How's that for a fat tail? fall below the 60-day, that was the day of the flash crash, by the way. Fall below the 60-day EMA, and now look at the oscillator. It's trading between 0 and minus 40 and minus 60. Just reinforcing what we saw on the weekly chart of the Dow Jones Industrial Average. All right, uptrend psychology. Volume goes with the trend. Edwards and McGee. You all learned that for your MTA 1 exam. Long-term investors tend to accumulate shares gradually, leading to a shift of the demand-supply outcome towards demand, which in turn leads to waves of higher lows followed by higher highs. Or, as I put on the little boards, more buyers than sellers. That's a lot easier to say than all this. Volume tends to increase upon reaching new price territories and decrease during downward corrections. That's what you want to see. In pullbacks, in a bullish trend, you want to see volume contracted. The oscillators react to the volume behavior by staying in the upper zone between 0 and plus 40, indicating more buying pressure than selling pressure, and that's what we saw here, between 0 and plus 40, plus 60. Now, let's have the rubber meet the road, eh? What are the uptrend buying rules? When price is above the 60-period EMA and ADX is greater than 18, you get a buy signal when either the VZO or PZO crosses from below 40, minus 40 to above minus 40, or you have a retracement down from plus 40 that fails to reach. We're going to look at this on the charts. You're going to see. Retracement down from plus 40 that fails to reach minus 40 is common in an uptrend. As we saw, you go from 0, you pretty much stay from 0 to plus 40. The oscillators will not reach the lower boundary and will rebound from a low above minus 40. Thus, crossing from below 0 to above 0 generates a buy signal. To reduce whipsaws, you can wait for a crossing from below 0 to above plus 15. What are the selling rules? When the oscillator rises above plus 60 and starts to go down, pretty much you want to sell unless it's the first time since the oscillator is over 60, since price closed above the 60 bar EMA. We're going to see that on the chart, but you get price go from below the EMA to above the EMA. The oscillator is rising. The oscillator gets to plus 60 or higher and starts to pull back. As long as price remains above the EMA, if it's the first time the oscillator got that high, since closing above the 60-day EMA, stay long. There's a lot of buying pressure there. Obviously, it's not going to keep going up indefinitely. There's going to be some profit taking going on. Give it its due. Let it run. Give it a little time to run. Doesn't work all the time, but it usually does. A second selling rule, when you have a negative divergence at an extreme level and the oscillator breaks below plus 40, or when the price goes below the 60-period EMA and the oscillator falls below 0. So you got 2 buy entries, 2 buy entry rules, 3 selling rules. All right. It's a lot easier to see this on a chart. This is a chart of EWU. Right? That's the UK ETF. Unfortunately, it's the only UK chart that I've got. I don't subscribe to any of the London Stock Exchange, so I don't get their quotes, unfortunately, in charts. But this was recent. I did this a couple of weeks ago. Although I ran it back a few months to get what I was looking for. All right. So we've got the 60-day EMA. Here's your ADX. Remember, the blue line is 18. All right. So let's look at some buys and some sells. Price fell below the 60-day EMA. Is this a bullish trend or not? Or a bearish trend? Price is below the 60-day EMA. It's a bearish trend. You wouldn't look to go long. Regardless, doesn't matter what happens, what it says here. You wouldn't look to go long. All right. We closed above the EMA here on this day. Back above the EMA, so we're bullish. The VZO was telling us, now we dropped down, here's the black line 0 and here's -5. Touched down to around -5 and then came up. Depending on whether you do a crossover through 0 as a buy signal or wait for it to get up to +15, this may have been a day to buy. May have been a day to buy. I wait for +15 because the next day it went down. Now the day I bought is even higher still, but I don't care. I'm more interested, I'm at the point in my life where my clients, I'm less concerned with how much I make, I'm more concerned with how much I don't lose. All right, come this day, price is above the EMA, and the oscillator is back above +15. Here's your buy signal, right here. And it closed that day, I was around 18 and a half, 18 and 3/4, give or take. And it went up and up and up. And the oscillator got well above, the VZO got well above +60. And then it started to come down. Now remember I said, normally, if selling rule number 1, if the VZO, PZO rise above +60 and starts to go down, you would sell unless it's the first time since over the 60-day EMA. This is the first time the oscillator got to 60 since the price got above the EMA. So even though the oscillator started to turn, we'd still stay long. We then fell below -40. Price kept going up. We definitely have a bearish divergence here. Price is making higher highs and higher lows. The oscillator is coming down hard. Trading with selling rule number 2. When a negative divergence appears at an extreme level and the oscillator breaks below +40. This line is +40 and it was well below +40. So we would have sold here, which was the end of this day. We would have sold around, it was around 19 and a half. So we got in at around 18 and 3/4, 18 and 5/8. We got out at 19 and a half, 19 and 5/8, call it 19, call it a point. And we held it 1, 2, 3, 4, 5, 6, 7. We sold it on the 8th day. So roughly 2 trading weeks, a point. Beats a sharp stick in the eye. Better than a loss. We had a huge up day here. This is where you kick yourself in the head. But look what the oscillator did. The oscillator was making lower highs. A serious bearish divergence. Serious bearish divergence. And then it pulled back and back and back and back and back. And we're below the 60-day EMA. And we came down to -40. And a few days later, we're back above the 60-day EMA. And the oscillator is rising. And here we're back above +15. Or if you wait for a cross above 0, you'd have bought the day before. So you're rated here. And a few days later, the oscillator is above 40. It's between 40 and 60. That's good. It's not at an extreme yet. But look what happened over the next few days. Price made a higher high. Oscillator made a lower high. Bearish divergence. And when it closed below 40, just like here, we got out. You got in here, you got out there. You made again about 3/4 of a point, but this time only took less than a week. The EWU moved sideways, down to sideways, but the oscillator came down to -40, and here it barely got above zero, did a little bit better here. Although I didn't mark it, if you were doing a cross above zero as your buy determinant, you had to buy here, you had to buy here, down here. But you can see because this trend, this is why I like waiting for +15. Okay, I'm going to go about 5 more minutes and then we'll take a break. Everything we've looked at so far is uptrend psychology. Let's look at downtrend psychology. Pretty much just the opposite of uptrend psychology. During a downtrend, volume rises with falling prices and falls during upward correction. Long-term investors lay off shares gradually, leading to a shift in the demand supply outcome toward the supply, which in turn leads to waves of lower highs followed by lower lows. In other words, more sellers than buyers. VZO-PZO reacts to the volume behavior by staying in the lower zone between 0 and -40. What are the sell short rules? Pretty much the opposite of the buy rules. We only want to short when price is below the 60-day EMA. Why? Because that's a bearish trend under the strategy. And we want ADX above 18, greater than 18. We want it to be a trend. You get a sell short signal when the oscillator crosses from above +40 to below +40, above reversal. This is just the flip side of what we saw before. Retracement up from -40 that fails to reach +40 is common. The oscillator will not reach the upper boundary, will fall from a lower high, fall lower from a high below +40. The crossing above 0 to below 0 is a sell short signal. Produce whipsaws. We can wait for a crossing from above 0 to below -5. I'm going to ask the question again. Now I think you'll be able to answer it quite easily. What are our zones? +60, +40, +15, 0, -5, -40, -60. Why is it +15 and why is it -5 instead of the same? Yes?
Is it because the bearish markets are more pessimistic?
I think that's the British way of saying they fall harder than they rise. Yes, exactly. Markets fall faster than they rise. Stocks fall faster than they rise. Everybody's got an excuse not to buy something, but when it's get me the heck out of town, get me out of here, everybody heads for the exit at once. We don't want to stick around any longer than we need to. Right? When a stock or an ETF is going down, it's like fish that's been sitting around for 2 or 3 days. It was great the day you brought it in the door, but now it stinks. Get rid of it. Get it out of here. All right? Well, there's no sense in being the last man out the door. If we can be ahead of everybody else, or at least in the front of the line, that's great. I don't mind getting in a little late. I want confirmation. Theoretically, a stock or ETF can rise and it can go indefinitely. There's no upper limit. There is a lower limit. I don't want to test the lower limit. Okay. What are the covering rules? Again, just the opposite of what we saw with the long rules. When the oscillator falls below 60 and starts to go up, here we don't have to worry about the first time below the 60-day EMA, because if it's going down, you don't want to hang around. Second selling rules, when there's a positive divergence at an extreme level and the oscillator breaks above -40, or price goes above the EMA and the oscillator rises above 0. Let's just look at the chart and then we'll take a break. This, again, is the SPY of the SPY, the S&P 500 index, ETF, 60-day EMA. We saw the SPY earlier. We definitely have a rise in price trend. We had a buy signal here. We were above the 60-day. We fell below zero. We rose, again, either buy it here above zero or buy it here when it's above plus 15. I've done the charts both ways. We had a sell signal here. We've got a bearish divergence for reasons I showed you with the EWU. Let's look at some sell short. Flash crash, market below the 60-day EMA, rally attempt, big bearish engulfing bar here. How many of you use Japanese candlestick analysis, by the way, in your work? It's marvelous. It really is. A picture tells 1,000 words, and it's really quite valuable. Anyway, failure to get above the 60-day EMA. We use our sell short rules. Note, we're between minus 40, minus 60, and 0. We had a crossover from above 0 to below, again, either below 0 or below minus 5, depending on what it is you want to use. Either way, if you did that, you were a happy camper because the market continued falling off a cliff here. All right, let's if you don't mind, it's 8:10. Let's take a 5 to 10 minute break. So, no questions? Okay. Yes.
About the, I'm fairly new with this, but about the volume indicator specifically, how does the arbitrages actually affect volume? And does it affect this specific indicator?
It's a very good question, and the answer is it doesn't matter.
It doesn't matter.
Because for whatever reason, volume is what it is. Is a stock being manipulated? Absolutely. I just want to be on the right side of whatever they're doing to it. Why they're doing it, don't know, don't care. Okay? Is this technique perfect? No. No technique. It's not going to be right all the time. I'm right all the time, but I don't let my wife know that. But no, it really doesn't matter. In that respect, sir, it's like price. Price is determined. Why is the price doing what it's doing? Don't know. Is it being manipulated? For some stocks and ETFs, well, not so much ETFs, but some stocks, absolutely. We're not institutions. We're not multi-billion-dollar hedge funds. There's big elephants in the bathtub, and we're just little fleas down there. But I just want to get out when they're getting out and get in when they're getting in. Any other questions? All right. What we've been talking about so far is trending psychology. Let's talk about non-trending psychology, because we trade it a little differently. Non-trending periods is when the demand supply becomes neutral. You have periods of buying followed by periods of selling. The oscillator usually reacts to this volume behavior by fluctuating between plus 40 and minus 40. It's rare to get above and rare to get below. There's a balance. If the oscillator reaches the zone between minus 40 and minus 60, it usually means sellers have finished offloading shares, which increases the likelihood of buyers stepping in. And if the oscillator reaches the zone between plus 40 and plus 60, remember, this is during non-trending periods. And how do we know it's non-trending?
ADX.
ADX what?
18.
Excellent. Very good. My God, somebody's actually paying attention. I wish it was like that in the States when I've given the presentation. If the oscillator reaches between plus 40 and plus 60, it usually means buyers have finished accumulating their shares, which increases the likelihood of sellers stepping in. Having said that, it's fairly rare to see the oscillator get this low or this high and the ADX remain below 18. Oh, it can happen on a day like a flash crash. But usually you've got a pretty good heads up. You know it's coming. This is a chart of GLD, the gold ETF. Here's your ADX. The blue line turns to crosshatches when the histogram is below 18. And you can see there are lengthy periods when the ADX is below 18. Here is a day, or an example of when the oscillator got above plus 60, but the ADX was still below 18. I said, it happens, but it's fairly rare. But note from the oscillator, with exceptions here, it usually remains between, here it dipped just below minus 40, but it typically remains between minus 40 and plus 40. What are the buy rules? If the ADX is below 18, is less than 18, 2 buy rules. Buy when the oscillator crosses from below minus 40 to above minus 40, an oversold reversal. Or when it crosses from below 15 to above 15. One of the ways I like to use this in buying, and let me step aside for a minute and discuss a tangential topic, and that is money management. I am a big believer over the last few years of buying on dips. When a stock or an ETF or an asset is trending, I mean, it's great to buy, the old Bill O'Neill, buy breakouts, et cetera, but those haven't worked too well if you're using any sort of a stop loss, keeping your loss to 3 or 4%. So if you're trending, you might not have a good opportunity. I bought here, I'd like to buy more, but where? That's hard to do when it's trending. When it's non-trending, it's easier, because you could do an initial buy when the oscillator crosses from below to above minus 40, and then as the oscillator keeps rising, when it gets from below 15 to above 15, you can pyramid onto a position. Easier to do. What are the sell rules? 2 buy rules, 2 sell rules. The oscillator rises above plus 40, then use the sell rules when the ADX is above 18. If the oscillator never reaches plus 40, sell when it closes below minus 5. This is more common than this in non-trending conditions. What are the sell short rules? Pretty much the reverse of the buy rules. If the ADX is less than 18, you sell short when the oscillator crosses from above to below plus 40, or from above minus 5 to below minus 5. You can also use this to open a short and to pyramid onto the short. Short additional shares. Remember, ignore the relationship between price and the 60-period EMA when the ADX is below 18. It's important. What are the cover rules when you're short? I mentioned something as a side. Very interesting now with shorting. More and more, personally, I trade ETFs. Or I may still be buying stocks, but if I want to hedge a position or hedge a portfolio, easy way to do it is with inverse ETFs. I almost never, be honest, I haven't shorted in several years because I'll just buy an inverse ETF. I mean, I don't need to short a stock. I'm more concerned about the market rolling over like the Dow Jones is doing right now. So I usually don't use these shorting entry and cover rules very often because I'm doing index ETFs, and then I just buy an inverse ETF. But if you're shorting, this is what your rules are. False, you cover. If the oscillator falls below minus 40, use the close and cover rules when the ADX is above 18. Or if the oscillator never falls to minus 40, cover or close when it gets above plus 15. Let's look at a chart. This is the same chart of GLD, only now it's annotated. We're going to look at some buys and sells here. Again, this is we're going to be looking primarily at non-trending periods. I'm going to ignore the buy and sell possibilities during the trending periods. We discussed those earlier. Here's your EMA. Oscillator rose above 0 or above plus 15. Does it matter where the price is relative to the EMA?
No.
Buy?
No.
Yes or no?
No.
No.
No, why not?
Oscillator.
I'm sorry, I didn't hear.
Non-trending.
Non-trending? Correct. Because the ADX is below 18. It's nice that it's above the EMA, but it doesn't matter. We bought here, it reversed, it closed below -5 in non-trending. We sold, we bought here, we sold here, lost about 3/4 of a point. Guano happens. Not all winners. The clock moves forward. The VZO rises above 0 or above plus 15. This now, so if you're doing a crossover above 0, right? Remember, we're buying here. Crossover above 0, that would have been this bar right here. Would you have bought? Here's your EMA. Right here, would you have bought? Forget that you know what happened. Is that a buy signal? Yes or no?
No.
No? Why not?
It was below the moving average. A bit,
Yes, it's
yeah.
below the moving average.
Yes. And the ADX is below 18, so it was not a buy.
Is he correct? Is Trevor correct? Trevor's not correct. Okay. Why is Trevor not correct?
You have to wait till it gets above plus 15.
Well, that could be. You can either do it crossing above 0 or above plus 15. Let's say you're using it crossing above 0, which is acceptable.
There is one.
So why was Trevor incorrect on that, on this not being a buy day?
Because it's a non-trending market.
Exactly. Very good, sir. It's a non-trending market. The first rule of non-trending markets is ignore the relationship between price and the EMA. All right? Strictly go by what the oscillator is doing, because we're below 18. So, if you're buying above, on a crossover above 0, there's your buy day. If you're buying on a crossover above 15, your buy day was in here. I have trouble isolating the exact bar with TradeStation, so it was in here. All right? So we went long, and the VZO went above 18 and started to come down. ADX is above 18, and we fell below 40, get out. Long somewhere in here, sold here. We made a nice piece of coin in a couple of weeks. Move the clock forward. We had multiple buy signals in here. Here, now, right here was the day, well, again, you could have had a buy signal here. I didn't identify all of them. On a +5, on a +0, on a crossover through 0, or a buy here, on a crossover through 15. We had here, multiple buy signals here. The important thing to take away from this is to remember, when the ADX is below 18, your buy and sell signal, so your buy signals are strictly based on the oscillator relative to its zones. Don't worry about price. and the EMA. If it goes in your favor, so much the better. Now, everything we've discussed so far is the VZO. What about the PZO? Looks pretty much the same, doesn't it? That's because it is the same. It's interpreted the same way. It's analyzed the same way. All the techniques we've discussed work the same. Here's the DIA, which is, they used to be called the Dow Diamonds. That's what I refer to it in my blog every day. It's really the Dow Jones 30 ETF. We do it the same way. ADX above 18. Price jumps above the 60-day EMA, either above 0 crossover or a plus 15 crossover. You know. Here we got above 60. It's starting to come back down. First time since it was above the EMA. So we hold longer, et cetera, et cetera. Everything we discussed so far. It's interpreted the exact same way. Which leads to the obvious question. If they look the same, if they're interpreted the same, why do we need them both? And point in fact, you can successfully trade using just one or the other. So why have both? Because when you've got both, now you can parlay one of the strongest technical indicators there is, and that's divergence. You can parlay these into using divergence. There's actually two types of divergence here that we use. Divergence between the oscillator and price, and divergence between the two oscillators themselves. The first one is the common one. You see this all the time. You're just looking at a chart with volume. That's all you have is price and volume. And the price is going up and the volume is going down. That's a potential bearish divergence. Very simple. Divergence between price, divergence between an oscillator and price, or a technical indicator and price. The real power comes here between the two indicators, two oscillators themselves. Usually the VZO and PZO are in sync with each other. Edwards and McGee, TA 101, volume leads price. That's in an up market, that's bullish. In a down market, that's bearish. And when I say bullish here, I didn't indicate, I meant in a rising market, in a rising trend. VZO leading PZO is bullish. Price leading volume is bearish. Unless you're in a down market, in which case that's what you want to see. When you're trending, volume typically leads price. When price leads volume, check the ADX to see if a trend is losing strength. In the discussion, in an analysis of divergence, forget the relationship between price and the EMA. That's not what we're looking at. We're not using this to make a buy or sell decision, per se. We don't care about price and the EMA. Let's look at some examples. Let's look at an example of a bearish divergence. Here, and we're going to look at these live when we're done, I have PZO on the left, VZO on the right. They look the same. They are the same. This is Apple Computer. This is a few years ago. At this point in time, if you look at, well, what here, this is what TradeStation, how they do, what's the word I'm looking for? How they interpret what's here. On the last day, not here, on the last day, the oscillator was minus 22.43. But this shows, when you see these charts on your PowerPoint, what these means, the way TradeStation sets this up, these are the zones, 60, 40, 15, minus font, 0. Well, there is no 0. I draw in 0 manually because they don't put in 0. 60, 40, 15, minus 5, 40, 60. The 0 comes at the end. It doesn't come in the middle. That's what I'm saying. All right? So don't think this was, how the heck could that be minus 2243 when it's above plus 40? So don't worry about that. Anyway, this was around plus 45 on the PZO. But the VZO, actually, this was around plus 50. But the VZO was about plus 41, plus 42. Price is leading volume. That is a bearish divergence. Now, the reason we don't use this as, oh my God, it's a bearish divergence, we have to sell, is because on any given day, volume could lead price, or the VZO can lead PZO, or the PZO can lead VZO. We need to wait a day or two afterwards. What happens next? And we saw the next day, the oscillators started to roll over. All right? And but here, VZO is lower than PZO. Volume is leading price. Here, price was leading volume, but now volume is leading price. Not what you want to see in a bear trend, unless you want to go short or something. That was time, as we say in the States, to get out of Dodge. To head for safer shores. So that was an example of a divergence between the oscillators. This is a chart of the GLD, again, of gold. And here we're going to see examples both of divergence between price and the oscillator and between the oscillators themselves. Here, GLD had bottomed out, was making higher lows and higher highs. The trend was higher, but, and the price is the same on both VZO and PZO, by the way. But the oscillators were making lower highs. Divergence between price and the oscillators. And PZO was significantly higher than VZO. Divergence, bearish divergence between the oscillators. That's higher than this. Not good. Not good. It tells you that this price rise was suspect and may not continue. And look what it did. It ran right. Don't ask me how this works. All I know is it does. Okay? It's a freaking magnet, but it works. Right up to the 60 EMA, boom. And then it fell down again. It just works. All right. Let's look at an example of bullish divergence. This was very important. TLT is the ETF for the 20-plus year Treasury bond ETF. We had a falling ADX, but it's still above 18. Price is still above the 60-day EMA. This is PZO on the left and VZO on the right. See, this is why I wish I had a pointer so you didn't have my big head shadow in the way here. Price was making lower lows, but the oscillators made a significantly higher low. It's still below zero. So, bullish divergence between price and the oscillator. Here, the VZO bottomed at minus 45, but the PZO at minus 45, the VZO at only minus 39.50. And this was higher than here, and this was lower, and this was high. This was lower than here. The VZO was higher than the PZO. We had bullish divergence between the oscillators. The VZO was every step of the way doing better, if you will, than the PZO, a bullish divergence. Move the clock forward, a huge gap in here, and then an accelerated rise, big bearish candle here, harami bar the next day, right? Harami bar is Japanese for pregnant. It's something like I'm Alfred Hitchcock. Bearish candlestick up here, but note the oscillator. Most of the oscillators. Right when we had, just before we had this gap, by the way, I meant to touch on this. The PZO was only 22, but the VZO was 40. VZO was strong, volume was strong. Now in here, we had this accelerated price move. Let's forget what you're looking at here. Bearish candlestick here. Higher lows, higher highs, but look at the look what happened here. Although PZO nominally made a higher high, VZO actually had a slightly lower high. Bearish divergence between price and oscillator, bearish divergence between the oscillators. PZO making a higher high and VZO not. When this fell below 40, get out of town. And your sell hopefully would have been here and not here. But even if it was here, you still avoided the further drop. Right. So you say you want to learn more about the VZO and PZO. Trevor knows this. Maybe some of you others do as well. I started about 5 years ago, I was still working, a daily blog on ETFs. Not doing it this week because we're on holiday. ETFroundup.com. Periodically, I don't talk about the VZO, PZO all the time, only when something catches my eye and it can be explained or analyzed using these oscillators. But you go to etfroundup.com. If you'd like to read more about the PZO and VZO, on the home page is a search bar. If you put in 6.29.10, that was in the States, June 29th, 2010, that's when I first wrote in the blog about the PZO, VZO. And I also wrote about it on the next day, on the 30th. Or you can just put in the search bar VZO, and it'll bring up every blog post I've written about the oscillator. On the 16th of July of 2010, I wrote about divergence. And it's pretty much what I talked about tonight in the presentation. But I expand on this in other blog posts that I've written. If you're a subscriber to Technical Analysis of Stocks and Commodities magazine, Waleed and I published 2 articles in May and June of 2011 on the VZO and the PZO. So if you're a subscriber, you can go online and you can read the articles. Now, these oscillators have been coded into many charting and quote platforms, as you can see. If you've got Bloomberg, you've got VZO, PZO. I don't know how many of these are used or available in the States. Obviously, I know Bloomberg is. And there's more since this PowerPoint was put together. It's becoming very popular, and it's on many trading platforms. So, let's wrap things up. The PZO and the VZO revealed 2 important aspects in the market: price and volume. The oscillators aid in analyzing and defining strengths and weaknesses within a current trend. The Divergences anticipate important turning points in the trend. Again, if you pull nothing away from tonight's presentation, remember divergences. When volume starts lagging behind price and the ADX begins to weaken, bearish divergence between the oscillators give traders advance warning about upcoming non-trending price action. When the ADX begins to rise and the volume again leads price, as we saw here, although the ADX was falling, but volume, the VZO is leading the PZO. The bullish divergence enables you to enter trades earlier and position themselves either for a resumption of the trend or for the initiation of a new trend. And that concludes the presentation. Now, let's see what the Dow is doing. Oh my, down 300 points. Market closes in 15 minutes in the States. Let's take a look.
You know what the S&P is? 500.
It is right here. It is down almost 37 points, or 1.87%.
Dow's down 300.
Down is down 294.50. And speaking of the S&P, here it is on the weekly chart, with the VZO on the left and the PZO on the right. I said that backwards. The PZO on the left and the VZO on the right. Now, everything you just saw, let's look at it in a real application. I want you to look at this, and just within the past, these are weekly bars, within the past couple of months, tell me what you see that tells you whether there is a bullish or bearish divergence. If you want to stand up so you can point on the, just don't write on the screen. Or you want to point it out, please. Somebody point out where they see a bullish or bearish divergence here. It can be between price or between the oscillators. Trevor.
Well,
Trevor, you want to stand up? It's probably easier.
Okay.
Give him a hand. It's Trevor.
I hope I get it right now. Well, we've got the high here and the lower high here.
Right.
High here, lower high here. And I'm looking also at the divergence between the two. So here we went above 40
Right.
here, and here we didn't make it above 40.
Good show.
Good.
Excellent. Excellent. I'm so glad you saw that. Above plus 40. Not even close. The market kept going higher. The oscillators kept going lower. Now, we did have a higher high on the oscillator here, but still well below plus 40. Well below plus 40. That's this week's bar, and the markets will close in about 12 minutes. Let's go to a daily chart. Oh, I'm so glad we have, so glad we have internet. This is a daily chart. Here's the 60-day. Of course, before it was the 60-week. And you can see the S&P had been moving sideways, pretty much. The ADX had been falling off. Oscillators, the VZO and the PZO, trading in a narrow band. Of course, we have this falling off the cliff bar today. This shows what Trevor was talking about, only seen on a daily bar. Now, of course, we're looking at dailies. Here's plus 60, well above plus 60. Not as high above plus 60 here. Same thing here. Falling off. So a little easier to interpret with the weekly bars than the daily bars. Is there any stocks you'd like to look at? I don't know what you all follow that we've got in the States.
NASDAQ.
Do you want the NDX or the NASDAQ composite?
Composite.
This is the daily chart. Let's go to the weekly chart. Whoops. Stop it.
Thanks, great talk. I'm going to go in there.
You're welcome. Glad you enjoyed it.
Great stuff.
Sorry to keep you all here so late. This is the weekly chart. Look at, talk about a bearish divergence. Look at how high the PZO got relative to the VZO. And the bearish divergence between price and the oscillators. I mean, this is what I mean. And of course, the trend was losing strength. But this is what I said earlier. These indicators work well in uptrending, downtrending, and non-trending markets. Very unusual for what we call an oscillator.
Hey, do you use 18 for weekly as well as?
Yes, sir.
We do.
Weekly, intraday, doesn't matter. The parameters do not vary. They're the same for both. Now, you can see relative to the S&P that the NASDAQ is doing much better. I mean, the S&P just totally fell out of bed. NASDAQ, not good, but the relative strength of the NASDAQ has been much stronger than the S&P. Let's take a look at gold. Well, this is daily. I shouldn't say that. Right? Here's GLD. Recently, the ADX fell below 18. I mean, this is just this textbook. We had one day where it was above the 60-day EMA, and the oscillators were both above plus 60. That much higher than VZO. Boom. If you were going to sell short, that was the day to do it. And worked out fairly well. Let's go to, or I said day, I meant week. Let's go to a daily chart. Then I'm going to look at bonds. Trendless right now, the past week. And you can see that the price has been choppy. There was a buy opportunity here. I would have gotten you out down here. Actually, you would have lost money on the trade. Again, it happens. Let's look at bonds. So weekly of the U.S. Treasuries. Right? Price rising. Oscillators falling. But the VZO was a little bit ahead of the PZO. The trend, again, this is weekly, is still bullish. How do we know that the trend is bullish? A couple of ways. How do we know the trend is bullish? Hello?
Well, the VCO has made a higher, looks like it's made a higher high.
Well, that may be.
The ADX is also ramping up and giving you strength in the trend.
But how do we know, just looking at the oscillators, how do we know that the trend is bullish?
It's 0 to 40.
Excellent. Because it's remaining between 0
and the 40.
and around 40. So, it is 5 minutes to 9, and you all have to go to work tomorrow. So, unless you want me to show you more, I thank you for the opportunity to present tonight.
I don't know if there are any questions for Dave?
Yes, any questions?
Yes.
Yes,
So
sir.
did you cover how to calculate the P0 and V0 when you first started this?
No, I didn't cover it because that's done in the charting programs. Yes, I covered it in that it's added to or subtracted from. The actual mechanics of how it's done, I let the software do that. If you read the articles in TASC magazine, or if you read them on my blog, etffirms.com, you'll see the formula how you can calculate them. Any other questions? Yes, sir.
Is the divergence signal with P0, is it more powerful than with, say, just using a MACD on our side?
Once you know how to interpret them, yes, I think so. I think they are. If you can incorporate this into your trading your charting platform, it is incredibly powerful. It's one of the most powerful indicators. When the two are used in conjunction with each other, particularly looking for divergences, it's one of the most powerful set of indicators I've ever worked with. Any other questions?
Sorry, does it work for Forex?
Excellent question. And the short answer is, I don't know. And the reason I say that is because all the back testing that Waleed did, all the back testing that I did, were with equities and equity markets. There's no reason why it won't work with Forex. I mean, you know, moving averages work with Forex, they work with stocks. I mean, but I can't tell you, well, we know statistically 63.5% of the time it's going to give a positive outcome. I can't tell you that with Forex. So I don't know. But why don't you try it and give a presentation in a couple of years and let us know. Other questions? Again, thank you very much for the opportunity to present to you.
Thank you. Thank you.